Has venture capital abandoned early stage startups? Find out next on An Acquired Taste. Dan Primack wrote a blurb, I wouldn't even call it an article, for Axios, and he shared a bunch of data points that I thought were really interesting and captured what we've been watching in venture capital and in startup financing for at least a year now, maybe a little bit longer, which is this move away from early stage investing. And we've created a little bit of a donut hole, for lack of a better term, in between kind of pre-seed and seed stage venture capital and Series A, more specifically Series B. And he shared a couple of statistics that highlighted this, right? Which is 46% of all seed deals were bridge rounds in Q1 of 2025, which is the highest bridge rate for any stage since Carta has been tracking the data. Series A deal count fell 79% between Q1 of 2022 and Q1 of 2025 based on Carta's data. And it doesn't necessarily get better for Series A. The median time between Series A and Series B rounds hit an all-time high of 2.8 years in the first quarter of 2025. So it begs the question of why is this happening? And Dan restated the belief that market volatility is what's driving less Series A activity, less Series A investment. And that's probably part of it. But I think there's some more basic issues at play. Number one, investor liquidity just sucks right now. It's not good. It's not improving. You're not seeing a flood of IPOs for these Series D, E, F, G startups that aren't going into IPO, therefore aren't creating liquidity events for their investors. You don't see a lot of M&A activity. There's a few outliers for sure. Google's made some huge acquisitions. There's been a couple others. But in general, for the other than the absolute marquee deals that you see out there, there's just not a lot of M&A or IPO activity, and that's creating less and less liquidity for investors, so their money is tied up. Fundraising has been consolidating into the biggest kind of mega funds and fewer of those mega funds, which makes small investments in things like, Series Seed or Series A investments less attractive because they can't deploy as much capital into those deals as they would like, because they're trying to deploy hundreds of millions of dollars in a relatively short period of time. So just basically not attractive for them. It's too much work to deploy too little capital based on the size of their fund. And if it sounds like I'm throwing those funds under the bus a little bit, I kind of am, because more and more of these funds, as they get bigger and bigger, are acting a lot more like investment bankers than they're acting like venture capitalists. They're applying investment banker mentalities, investment banker metrics, expectations on startups that historically venture capitalists haven't. That's what makes the asset class different than that. So as they get bigger and they get more conservative, I'm not really sure they offer a lot of differentiation and frankly value over an investment bank. Investment banks may actually be more valuable at that point. And then the downstream effect is fewer middle market funds and early stage managers are raising capital or starting new funds. And that's a problem, because if you look at the deal count, total deal volume of where Series A deals and financings happen, they happen in those middle markets. They happen in those smaller funds. They happen with some of those early stage fund managers that isn't happening in those mega funds that I was just talking about. Just wanted to say thanks. We recently hit 100 subscribers, and that's a big deal to me. May not be a big deal in the world of YouTube, but it certainly means a lot to me that you would subscribe to the channel. If you're not subscribed to the channel, help us reach our next goal of 200 subscribers by subscribing today. And the market's reacting to all of this. So first and foremost, there's a reason why you're seeing so much dialogue from founders and advisors and talking heads, like me, about bootstrapping and self-funding startups. People are realizing it's hard to raise money right now, especially at early stage, and they don't want to get caught having made all of these commitments to employees, made these commitments to investors, and then find out that there's no Series A money or even any post-seed early stage money available. The zero interest days or ZIRP era of funded companies with huge growth trajectories but narrow paths to profit, that's changed. People aren't willing to take those risks. Borrowing money or the carrying cost of debt has gone up significantly. They're not as interested in doing that. So come 2024, investors started to push, for better unit economics, paths to profitability, capital efficiency, de-risking behavior. They were asking for things that warrants, dividends, things you didn't typically see in early stage deals are now trying to make their way back into investment terms and expectations from those investors. And that has been something that's developed over the last year. One interesting statistic was the National Venture Capital Association published this in their last quarterly report that 76% of completed acquisitions in Q1 of 2025 occurred before a Series B was raised, which meant that founders are getting out when the fundraising dries up, and presumably they're doing it at depressed valuations or for pennies on the dollar relative to where they had hoped to be at that point. But if there's no more money and the best path forward is to be acquired for some amount of value, that's certainly better than just closing your doors. This all leads to the fundamental question of what should founders do? I think there are two scenarios, and I'll break those down. The first one is, let's assume that this is a persistent condition of the market, of venture capital, and it's not going to change anytime soon. The second scenario is the dry powder that has been building up in VC, stacking up in VC funds for now 3 years, is starting to flow outward again, maybe back into the earlier stages of growth companies, Series A, post-seed, even maybe seed stage, because the growth phases of B, C, D have just gotten too frothy. There's too many people writing too big a check, or too many people trying to write checks into those deals. Therefore, the valuations have to go up. They get frothier, and maybe they don't represent the same value that they did before. And it's not like we haven't seen that happen, where the later stages get so expensive and so frothy that even the biggest funds start secondary funds to go farther upstream or earlier in a startup's progression or vintage. So into Series Seed, into pre-seed. Andreessen Horowitz did it. They announced that they had this early stage pre-seed fund. And I actually thought that was probably bad news for the rest of the pre-seed market, but I don't know how long they really stuck with it. I didn't hear very much come out of that fund, but even some of the larger funds like an Andreessen Horowitz came out of, or firms like Andreessen Horowitz came out of periods of time where things got very expensive later in the stages and decided to go more upstream. So it's possible. But let's just start with the second scenario that I was just talking about first, because I think that's the easiest to understand, contemplate, navigate. And that's pretty simple, right? So how long can you go before you run out of cash, right? That you can survive in advance long enough for the dry powder to start flowing outward again. How lean of an operation can you run to extend your runway, to extend your cash reserves? Are there any other quick paths to revenue that would generate some sort of operating income? So widgets, early release of a product, partial release of a product, a feature release of a larger product, design partnerships, paid pilots. What are some of those alternative paths to revenue that are much faster than where you are right now? And all of this, again, is to just kind of survive and buy time for some of those financings to thaw and for that capital to start flowing to the earlier stage. Now, the first scenario, and again, just as a reminder, is that we assume this is a persistent condition and it's not going to change anytime soon. That scenario is a little bit tougher, obviously. But let's start with assuming you haven't raised any money yet. You're an early stage founder. You're looking at the market. You're going, geez, I don't know if I want to raise money. Maybe I'm going to bootstrap. I haven't made a decision, but in any case, you haven't raised money yet. You have a couple of options. And optionality is gold at an early stage. So option number one is bootstrap for longer. Very straightforward. Build slowly if you have to. Self-fund. Take a side hustle to generate some funding. Treat your startup as the side hustle. Don't quit your job. Try and land a few small paying customers and manufacture some patience. Very hard to do, but very important and potentially very necessary. One of the most successful founders that we've had in Birmingham was building websites on the side just to generate enough personal income for him to stick with his company. And I think we're all glad he did, because eventually that company became a $1 billion company, a true unicorn. And it was a great example of doing what you have to do to extend that runway and to create some options for you in an early stage, because he wasn't ready to raise money. And so by the time that he had created that runway for himself, he was able to figure out and move forward rather quickly. And then option two is raise a pre-seed or seed round from an investor who is prepared to participate in bridge rounds to get you through to a Series A. This is something you can figure out on the front end before you take investment from somebody, simply by having that candid conversation with them to say, if I struggle, are you able to support me through some bridge financing? Are you prepared to put a little bit more money in if it takes slightly longer for us to accomplish what we're trying to get done? And then finally, option three is go raise your seed round and assume you won't raise your Series A for at least 3 years. You need to share that plan with your investors. You need to ask for their support. You have to set a strategy based on that assumption, based on that timeline. It's going to force you to hire less people. You're going to hire them more slowly. It's going to force you to nail your go-to-market strategy. You're not going to have a lot of margin for error there. It's going to create constraints for you and your team to be incredibly thoughtful, be measured in almost every decision that you make. To be clear, constraints are incredibly helpful. They don't feel like it at the time, but when you have those constraints, it forces you to really think through how am I going to execute at a very high level, because I get one shot at this, right? This has to work, and I don't have any other options. And then drive the deepest possible understanding of your intended customer and market. I say this on podcasts all the time, but the biggest waste of resources, time, capital, investment, fill in the blank, comes from taking your eye off your core market. You start building stuff for tertiary needs. You start chasing, beliefs or thoughts or something that came to you in the middle of the night, like a fever dream, and you get distracted from those core customers. And that's where you start to waste time, energy, and money. And early generation revenue is going to be absolutely required. This is not something where you have time to build the perfect product before you take it to market. You need to take it to market as soon as is possible to charge money for it. Here's the good news. In this third option, if you nail this strategy, you're not only likely to survive or more likely to survive, but you're far more likely to attract Series A investment, because you've now created what all of them are looking for, but not necessarily finding in the market at the volume they'd like, which is a capitally efficient company that makes money, executes at a very high level, and shows the capacity to scale with a little bit more investment, which are all things that those investors looking for that series of investment have been looking for the last year and a half. If you can build a company in that model, you're going to stand out amongst everyone else that is also trying to raise that money. Now, if you've already raised money, Don't despair. You can still borrow from a lot of these tactics. If you're now looking at a very short runway, similar to somebody who did raise money or similar to somebody who hasn't raised money, if you've raised money and now you've got a short runway, don't let that stop you from applying some of this same strategy. Ask yourself how long you can go before you run out of cash. How lean of an operation can you run? Are you really running the leanest operation that you can? Maybe that requires a reduction of workforce. Maybe you got to lay some people off. It's not fun. Nobody wants to do those things. But how are you going to survive long enough to either see this capital investment coming back to earlier stage, or you generate enough revenue and operating income that you extend your own runway? And again, are there any quick paths to revenue? Are there ways for you and your company to make money while you're waiting for that investment opportunity? So there you have it. Has venture capital abandoned early stage startups? Kind of feels that way. And even if that's not actually true, probably doesn't hurt to act accordingly as a founder and as an early stage startup. Be capitally efficient. Be built to be resilient. Take a measured approach. Generate revenue early. And then what you're going to create is more optionality for yourself in the long term. And that's really what you want as an early stage founder and as an early stage company. Options. Create more options for yourself. Set a great strategy and follow through. That's it for this episode. Thanks for checking it out. As always, like, comment, and subscribe.